Hi. The earlier videos which we have seen, we touched upon budget, how to read the numbers, and there, while talking about capital receipts, we had spoken in briefly about borrowings, how much the government is borrowing. So, that is the bond market. When borrowing comes, we'll quickly recap. We are paying a lot of interest. 4,83,000 is the interest which we are paying as per the revised estimates. So, uh, that's the borrowing. We have seen in one of our earlier sessions, we have spoken about interest rates and RBI and monetary policy. So these both the topics from the central government, which is the fiscal policy, and the RBI or the central bank with the monetary policy. So both of them together, when we talk about things like debt or interest, and obviously bond paper comes into the picture. A bond market needs to be understood. So today we will be taking off from these two topics and putting it at the bond market level. So whenever we hear the word bond, we are talking of a loan. Somebody is taking a loan, and whenever the word loan comes, we have to pay interest, and there has to be some tenor on that. Now, why also we must understand bond market is because when we use the word capital markets, now capital in the balance sheet can be in the form of equity or debt, and when both these papers are traded in the respective markets, so when equity capital is traded or when shares are traded, we say it's the equity market. Similarly, when bond papers are traded, then that is known as the bond market. Now, bond market or a loan can be of as small a duration as less than 1 year, or it can be slightly longish. Similarly, the who is the issuer of the bond, because if there's someone like someone who's very much trusted, or in simple examples, if we have to understand, if we have to put our money fixed deposit in State Bank of India and also some other cooperative bank, and if both of them are giving, let's say, 8%, then in that case we would be putting our money in SBI and not in a cooperative bank. Now, what we are doing here is we are essentially saying that if the returns are the same, if the return of the interest is the same, then I would like to go for something which is lower risk. So whether at a common man level, whether we know these terms technically or not, but we obviously keep thinking it in exactly the same way. So we would, if the returns are same, I would go for low risk. And if the risks are different, then if SBI is giving 8% on my fixed deposit, the cooperative bank should give me 9 or 10 or something like that. Only then I will be interested in even looking at the cooperative bank. So, depending upon who is the issuer, depending upon what is credit rating of the issuer, depending upon for how long the money is being taken, the bond market is affected by all these things. At a global level, India's current credit rating is seen. The government is trying to tell the rating agencies, whether it's Standard and Poor's or Moody's, or that our credit rating should become better, because with each passing year, with each passing month, we are reducing our fiscal deficit, we are making our balance sheet healthy as a public finance. Why do companies or countries want better credit rating? Because if the credit rating improves from, let's say, triple B minus to triple B plus or double B or A or triple A or whatever, as the credit rating improves, the cost of borrowing reduces for that particular entity, be it a government or be it a company. So in this case, clearly the credit rating of SBI is much better than that of a cooperative bank, and therefore SBI can borrow money. Fixed deposits for you are assets, but for the bank it's a liability, it's a time liability. So the cost of borrowing for SBI will be lesser because its credit rating is better. So that's what we need to understand, that when we talk about bond markets, all these things come into the picture. In case of India, typically our bond market is mostly government securities dominated. It's a GSEC market. Reason being, government is such a big borrower. 5 lakh crores the government has borrowed or something like that. So the paper which is there, whether it's short term T bills or long dated paper, it's known as dated securities. So majorly Indian bond market is government securities market, and if you remember in SLR we had said that when the government borrows, when it issues paper, then banks have to put some 20%, earlier it was 25%, so they have to buy that paper. So look at it any which ways, this is a big GSEC market, big government dominated market. Now when we say the word securities market, the securities exchange regulator is SEBI. But when it comes to specifically the government bond market, then the regulator is RBI. So this is a small point which we must, if there are any students watching, this can be an interview question also. The thing is, RBI is regulating only the GSEC market. Even the private corporate government, private corporate bonds, let's say Tata Motor issues some debentures or somebody else issues some bonds, or all those will come under SEBI, because SEBI is the securities market regulator, except for GSECs or government securities. They are also known as dated securities. So they are all under the regulation of RBI. So let us try to understand how these bonds are issued, how it works, and what is the simple bond mathematics. We will just try to understand one very important parameter in bond mathematics. So let's say for example there is a bond whose face value is, let's write it here, whose face value is, let's say, 100 rupees, tenor or the term is, let's say, 3 years, and coupon is, let's say, 8%. Now these are new terms. So face value is the value which at which the bond is issued, and this is the redemption value. At redemption you will get this much money back. The loan is for 3 years, and the coupon is the interest which you will get on this 100 rupees investment. Now this coupon, among other things, is also determined by yield, which may currently be 8%. In simple terms, for yield we may say that yield is the interest rates prevailing in the market. So if right now the interest rates prevailing in the market are around 8%, then any borrower would like to issue bonds at 7%. But if he does that, no one will subscribe to these bonds, because if you as an investor, if you are getting 8% somewhere else, why will you go for a bond which is offering 7%? You would, on the other hand, like 9%. But the issuer won't come out with a 9%, because if he can raise money from everywhere else at 8%, if this is 100 crores, 1% extra means 1 crore extra he is paying at interest. And so therefore at the beginning, typically the coupons will be close to what the current market scenario is, and therefore this is broadly, to start with, we can say that the face value is 100, 3-year bond, 8% coupon and 8% yield. Important for us here is coupon is fixed, whereas this is variable, and that's where the entire bond mathematics comes, because once you have invested, now nothing can be changed. But these interest rate, these will keep changing depending upon whether the government is borrowing more or less, whether rupee is appreciating or depreciating, whether China what is devaluating its yuan, whether US is increasing its interest rate, whether crude oil goes up. All sorts of things can happen. So this is a variable thing. None of us has any control on this, whereas this is fixed. And from here on, let us try to understand how our investments get affected because of the movement, because of the decision which we have taken, and subsequently because of the movements which happen. So let's see how. So let's try to draw. These are 3 years. Now on the first year, there is a cash outflow of 100 rupees. So therefore we are writing minus 100 here at time 0. Now after first year, we would be getting, pay attention, we are doing 100 into coupon 8%. We are not multiplying this by yield 8%. We are doing 100 into coupon 8%. So after 1 year, we will get 8 rupees as the coupon. After second year, we will get another 8 rupees. After third year, we will get the 100 rupees, which is our principal, and plus the 8 rupees. So this is how our cash flows are looking like. First year minus 100. Then time t0 minus 100, then 8, 8 and 108. This we know. Now, we must understand how are bonds priced. Now, pricing of a bond, let's write it down here, is bond price is equal to sum of present values of all future cash flows. The bond price is sum of the present values of all future cash flows. So let us go from right to left. All future cash flows. So these are our all future cash flows, 8, 8 and 108. We have to find out the present value. Now when we find the present value, we have to discount it. What it means is, if you are getting 8 rupees at the end of 1 year, and if the money is growing at 8%, now the yield 8% we are considering, then how much money you need to invest today? So this is what we need to calculate. And here we can use either Excel functions, or we can use discounting formula. Compounding is, let's do the mathematics. Compound is equal to P into 1 plus R raised to the power N. So in this case, because we have to calculate P, we will say P is equal to A divided by, and then the whole bracket. So 1 plus R raised to the power N. So that's what we are doing. This is compounding, this is discounting. So we are doing, this is what is of use to us, discounting. So let us try to find out. So we have got an Excel function. So is equal to PV bracket open. It says the rate. So rate will be 8%, comma. It says N per number of periods. So this is 1 after 1 period. PMT is 0. FV, let's write down minus 8. So the answer comes as 7.41. We just need to remove the dollar here. So what it says is, when you invest 7.41 rupees today, T0, for a period of 1 year at the rate of 8%, then it would have increased to 8 rupees. What it's saying is, the present value of this 8 rupees is 7.41. So 7.41 is the present value. We have to calculate present values of all future cash flows. So let us also quickly do it for the other two cash flows. There we need to make some slight changes in that, in the formula. So this will be again G7. This will be 2 years. So it will be I9, 0 and minus, it will be I12. So we get 6.86. So what it means is, if I invest 6.86 rupees for a period of 2 years, if I invest 6.86 rupees today for a period of 2 years at the rate of 8%, then my 6.86 would have increased to 8 rupees. This is what is the meaning of what we have done. Finally, let us do it for the third cash flow also. So the yield will again be G7. This will be N per will be 3, so it will be J9. J9 is the N per, and this will be K13. No, J13, sorry. So we have 85.73. So once we add all of this, the sum of all these cash flows is equal to 100. So this 100 which we are paying today is calculated because it is the sum of these three future cash flows. So the present values of all future cash flows is the 100. So the 100 which we are paying is actually the present values of the three future cash flows which we are getting. This is as of now, today. Now what can happen is over the next 3-year period, interest rates can go up or down. And depending upon that, now when I say interest rates, it is this, interest rates prevailing in the economy. So it is the yield which we are talking about. Yield is variable, coupon can't be changed, coupon is fixed. So let's see what happens. Now pay attention. If I do this 9, then immediately you will see that the bond price has come down from 100 to 97. When the yield is increased from 8 to 9, earlier it was 8, from 8 when I make it 9, the bond price has come down from 100 to 97, which means what? when rates up, so price down, PRIC. Let's also do this the other way around, 8. So if it becomes, now if I do this 7, we will see the bond price has increased to 102. So we will write down here rates down, price up. So what are we seeing here is that there is an inverse relation, and this is the first property of bonds. Inverse relations. What it says is bond prices are inversely proportional to interest rates. Bond prices are inversely proportional to interest rates. When rates go up, bond prices come down, and vice versa. So this is the first property which we must understand. Why we must understand this property is because there is a big mistake which many times investors make. Now what happens is, we have seen that when interest rates go up, bond prices come down and vice. Now pay attention. What has happened is, let's say this period when there's a general interest rates are coming down. Now when the interest rates were coming down during this period, because of the relation which we just now saw, bond prices would have increased during that time. So here is a time when interest rates came down, as a consequence of which the bond prices must have gone up. And during the same time, if we were to see let's say Nifty or any others, when the bond prices have gone up, people would start entering the bond prices at the highest levels, because the relation is not understood that bond prices don't go up by themselves, they go up because interest rates come down. So here is a time when interest rates have come down. So this point, when the rates are at their lowest, it also means bond prices are at their highest. It doesn't make economic sense to invest into bonds at this point. But most of the times it is observed, there is data of the Indian market that retail investors like you and me, we end up entering into bonds just at the time when the bond markets are at their highest, because we do not know the cause why it has happened. More often than not, we see past performance of mutual fund schemes, of gilt schemes, of dynamic bond funds. So we end up investing on the basis of something which really doesn't have any consequence. So from here to here, this was a huge crash in interest rates. The moment this thing happened, bond prices shot up. When bond prices shot up, people started investing in bonds that you should not be. When interest rates are high, bond prices are low, and when interest rates are low, bond prices are high. So instead of looking at bond price, we should be looking at yields, and yields can be seen from RBI website or some other websites also they give. So broadly, the 10-year GSEC and other, these are some of the things at a practical level. But at the most basic level, this is what we need to understand, that bond prices and interest rates are inversely relation, and we do not say interest rates are inversely related to bond prices. We say bond prices are inversely related to interest rates, because interest rates do not move depending upon bond prices. Interest rates move the way they move depending upon economic conditions, and as a consequence of which the bond prices move. So it's the bond prices which follow. So the independent variable is the interest rates, market prevailing, and the bond prices are the dependent variable. So this is the first point. Price of a bond is sum of present values of all future cash flows. Having understood the relation, when yields go up, bond prices come down, and vice versa. There are other ways also of explaining why this happens. Let's say, for example, in even more simple terms, when in the economy, if there is an investor, and in the economy, if the current yield is 9%, and if there is a bond available whose coupon is 8%, so if he has got 100 rupees, if he buys both these bonds at 100 rupees, then in this bond he will get 9 rupees, and in this bond he will get 8 rupees. Why will he pay 100 rupees for getting 8 rupees when there is another option available whereby investing the same 100 he is getting 9? So the yields will always be adjusting, and that's why the price will go down. Similarly, if the interest rates go down, suddenly this bond becomes more attractive. Why it becomes more attractive? Because other new bonds which are coming into the market, they are all having low coupons. They will have 7% as coupon. So the demand for this high coupon bond will go up. and therefore also the price will go up. So there's a logical way of looking at it, there's a mathematics way of looking at it. If you see, this thing is this 7% yield, this is coming, or here if we say, if we look at it in this particular form, then it is this R, instead of R we can write the yield. So this is coming in the denominator, and as the denominator goes up, the entire ratio comes down. So if you want to understand it mathematically, that's the way also it can be done, that when 8 becomes 9, then the denominator increases and therefore the entire value of the ratio comes down, and vice versa. So there are ways to understand, but this is what it is. Bond prices, sum of present value of all future cash flows, and interest rates. There's an inverse relation. When bond prices go up, when interest rates go up, bond prices come down, and vice versa. Now, if this much is understood, there is another small part which we can touch upon, and that is, here we have seen that this is a 3-year bond. Here we have seen this is a 3-year bond. Now, if we were to just take another example of a 5-year bond, so the cash flows will be, let's say 0, 1, 2, 3, 4. We just need to build this. So we are putting minus 100 here. Let's say this is 8, 8, 8, 8 and 108 over here. And let's say, for example, so we'll have to do the PVs also. So now we will try to do the PV not by using the Excel formula, but by using the discounting function. So is equal to divided by 1 plus, let's say YTM is here, R percent raised to the power n, and this we are putting as 8%. So we have got 7.4. We'll quickly build the others also. So is equal to amount divided by bracket open 1 plus 8% raised to the power 2 is equal to 8 divided by 1 plus 8% raised to the power 3 is equal to 8 divided by 1 plus 8% raised to the power 4, and finally 108 divided by 1 plus 8% raised to the power 5. So you add all of that and we get the total. Again we will get as 100 only, at least initially. It's exactly the same thing which we have done, but we have to see another point. Now it's the same thing. If I do the 8 becomes 9, so interest rates have gone up, so the bond price will come down. If 9 becomes 7, interest rates have come down as compared to the coupon, so bond prices have gone up. So the relation stays that when interest rates go up, bond prices come down and vice versa. Now let us compare these two bonds. Everything else is equal except that one is 8 years and one is 5 years. Now initially both are at 100, yield and coupon are same. Now let's see what happens when 8 becomes 9, this 100 becomes 97.47. So let us quickly write down for the short term bond. For the short term bond, 100 is becoming 97.47, whereas for the long term bond, now as compared to 5 years, 3 years is short term. If I do 9 here, then 100 becomes 96.11. So let me write it down here. 100 becomes 96.11. This is the 5-year bond, this is the 3-year bond. What are we seeing here? For the same change in interest rate, the long-term bond is falling more. For the same change in interest rate of 1%, the long-term bond is falling more than the short-term bond. Let us also see what happens when interest rates go up. So let's say, for example, when interest rates come down. So when 8 becomes a 7, this has become 102. So let me again write it down. The 3-year bond from 100, it has gone to 102.62. What will happen in case of the long-term bond? If this becomes 7, rates are falling down. So bond price has become 104. So let me write down here that the 5-year bond 100 rupee price has become 104.1. If we pay attention, so here it is, we can say this is rising more, and therefore our next observation or our next rule or property of bonds is, first property is interest rates are, bond prices move inversely to interest rates. Second property is the longer term bond is more sensitive to interest rates than the short term bond. Because when rates go when rates go up, both the bond falls, but this bond falls more. When rates go down, bond prices go up, but the long term bond rises more. So the long term bond will always either fall more or rise more. So therefore the property is long term bonds are more interest rates than short term bonds. So long term bonds are more sensitive to interest rates than short term bonds. These are the two properties which we have seen today in this particular session. These two properties are more than sufficient. These two properties are more than sufficient for an investor to take a good investment decision, an educated investment decision, an independent investment decision. Now, sadly, what happens is you and I can't directly invest in, we can, but then the process is pretty tedious. But a good alternative is bond funds, maybe gilt funds who don't have any credit risk. Maybe corporate bond funds also, if you are able to analyze the credit risk portion. The problem is many times the intermediaries who are selling us the bond funds, or even many times mutual fund employees, they themselves don't know these mathematics, and therefore what happens is when the rates have totally come down either here or here or here, they will end up telling investors to invest in bond funds. Because the rates have come down, because of that the bond prices have shot up in all the cases, and therefore they are showing historical returns, and investors are also like, okay, we are getting, this is a good fund, so we should be investing here. In the current situation today, as we speak in 2017 early, our 10-year bond is at 10%, at 6.5% yield, and our repo rate is also at 6.5%. So this is known as a flat yield curve. Whether you invest for 1 year or whether you invest for 10 years, you are going to get 6%, 6.5% only. Now, why will an investor put his money for 10 years if he is getting the same percent at least I will maintain my liquidity. So these are some of the points we should look at. Also, the 10-year GSEC, the 10-year GSEC today, which is at 6.5%, is amongst the lowest in many years. In many years, we have not seen 10-year GSEC yield at, when I say yield, I am referring to this point. I am saying this. So the prevailing market rates. So the 10-year bond, which is considered as the benchmark, as in Sensex, equities we have Sensex, so in the bond market there is a bond, which is, there are indices also, but 10-year bond is considered to be the most liquid and most tracked. So the 10-year bond yield is at its lowest, 6.5%, let's say. This low it has not come in almost the past decade, I don't know, maybe at least 5, 7, 10 years, which means interest rates have fallen as much as they could have. The probability of interest rates falling from here is relatively less. It's not that it won't happen, but you would have made real money in the bond markets had you entered when the yield was 9. So when 9 became 6.5, a lot of money would have been made. Now the 6.5, you don't really expect it to go down to 2.5 or 3.5. So therefore, the probability of making money in the bond markets at these low yields is as good as 0, if I may, or very less. Now, will the equity markets perform? Again, it is a function of some many other things. Let's not get into equity markets or other asset classes. But we must understand this, that we should, when the yields are at their lowest, it also means that the bond prices are at their highest, and therefore investors are better off by not entering bonds looking at historical returns, but rather asking the question, what is the yield, and comparing it with historical yields. Typically 10-year GSEC yield doesn't go above 9, 9.5, 10%, and typically it doesn't fall below 7, 6.5, if you will. So that's the broad range. This is not the time we should be all gung-ho about the bond markets for the reasons just now told. So this was about bond markets, two principles, inverse relation and sensitivity. There are a lot of other things, duration and all, which are not really required for the retail investor, but they are good points to understand for a finance student or a professional. Our next videos will focus on how we can move amongst asset classes within bonds, what is yield curve. So all these things are slowly getting linked to each other. Bond markets, now again, how are the yields also affected? Now if the government controls its fiscal deficit, the borrowing is less. So when the borrowing is less, the pressure on the new supply coming will be less, and when the new supply coming will be less, so that's a good thing. Bonds like that, I mean the bond markets like that. So therefore if the government borrows way too much, then there is something known as crowding out. What is crowding out? There are only so many resources in the economy. If a large part of that resources are taken by the government, then obviously little money is left for the private sector to borrow, and therefore the cost of borrowing goes up. So if the government, which is a huge player in the Indian market, if it keeps its fiscal position under control, and we have seen that it is slowly doing it, these revenue deficit and fiscal deficit figures, 2.5, 2.3, 1.9, 0.9, 0.7, 3.9, 3.5, 3.2. So as long as the government does a good job of its public finances, the pressure on the bond markets will be less. So because of that, interest rates won't really shoot up, and if the interest rates are kept under control at the government borrowing level, then subsequently at all other levels also the borrowing costs can come down. So that's a good thing for the bond markets and the economy as a whole, because we want inflation to be under control. For inflation to be under control, RBI needs to keep the interest rates under control. Interest rates can be kept under control if the fiscal position is good. Similarly, if there's good rains, the agriculture sector will start contributing, so food inflation can be controlled. So a lot of things come into the picture to give us a good interest rate environment scenario. We are seeing one of them, we are seeing each one at a time. In the next videos, we will also try to see some other components and take this discussion forward. Thanks for watching.